other people's money. Everybody talks about it as the best way to raise money for your startup. And today we're going to talk about what other people's money looks like, how you can get it and use it in your business, and what are some of the things that investors are looking for in this space. I'm really excited to have special guests with us today. Stephen Bowles, the founder of Catalyst Advisory.
Take the ego number off the table. People say, my business is worth $20 million. That's what I want. Yeah, no, what you really want is some number net. And so if you can get that number tax efficiently and it's structured a little bit differently and it benefits other parties as well, let's try to get to that scenario and not just ignore those other options just so you can say, I sold my business for $20 million. Because you're looking for somebody who has successfully generated cash flow in those and then successfully exited. But you also want to have those experts that sit there and say, okay, yeah, here's how you should actually structure your business right now. For these reasons, that money spent saves you significantly more later.
Stephen, thanks for being here.
Thanks for having me, John.
Stephen, tell me a little bit about Catalyst and what you do, because I think that'll be good background as we get into this topic.
Sure. Yeah. So a little bit of my background, I came out of the family office space. And so for those that aren't familiar with that term or just kind of heard it on TV, it's essentially where a wealthy family structures their world as a business, and then that's a family office. There's different aspects inside of there. So my specific role in there was working in an advisory group that worked with other family offices and high net worth families around structuring wealth transfer, estate planning, that type of stuff, and using life insurance. So that's my backdrop. And then I started Catalyst Advisory in 2022 to continue working with high net worth families, but also I've found much more of a niche with founders, investors, and entrepreneurs doing similar work around just putting strategy together for their wealth transfer. And the exposure that's given to me about how they structure their businesses has been super valuable and has really led to this conversation today.
Yeah, that's great. And as we've gotten to know each other, I've discovered the wealth of knowledge and experience you have around just how some deals are structured maybe in unconventional ways, where you have maybe a high net worth individual or a group of individuals who are investing, almost looking for deal flow in businesses that are growing and emerging. And so really looking forward to having you share some of the structures that you've seen.
Yeah, I'm happy to do it. The environment I was in kind of pulled back some of the veil of things that were very mysterious to me. And so some of the conversations I've been having over the last few years have just been people that hear terms like private equity, venture capital, those types of things that doesn't mean anything to them. And you can start to apply it and say, well, what that really means is here's how you're structuring something. Here's how you do it. It's something that you might be able to participate in even in the right environment.
Yeah, absolutely. Well, and a lot of times, thinking of it from an entrepreneur's perspective, there's always a lot of buzz around raising capital, and of course, everyone watches Shark Tank, or everyone sees these big kind of high growth, high speed growth entrepreneurial startups, and so everyone thinks in terms of those kind of typical pathways. The friends, family, and fools, and then finding nice angel investor, maybe like a local business incubator, and then moving into like seed and pre-seed and seed rounds and series A, B, C. So, that's sometimes it gets a lot of the attention, but of course, a lot of different ways to do that. Maybe just for anyone listening that's not real familiar with the landscape, maybe talk a bit about, just the equity fundraising versus like maybe debt financing. Might be helpful to just get some structure there.
Sure. Yeah, I can just talk about some of the things I've seen. There's a lot of attractiveness to equity, and equity just means ownership, right? If we're just going to differentiate and define things out, ownership versus debt. So the positives with that, if you're the founder and you really believe in what you're building, and depending on what kind of business it is, et cetera, you sit there and say, I want my equity because it may not be worth a lot today, but where I'm heading to, what comes with it is the upside, but also control. If you're the investor, you also kind of want the equity, right? If you believe in the vision that the founder's presenting to you and the asset class and whatever there, then having an equity component is very attractive. So you're both kind of attracted to the same thing. The debt side, if you're on the on the entrepreneur side and you're the founder, then the attractive thing about debt is, hey, I don't give up any equity, but it's going to cost me something, right? I've got to make sure I can cash flow this. And on the investor side, you might sit there and say, hey, as long as I just think there's solid financials there, I'm going to take some of my risk off the table, not go after the upside, and get some nice returns because I'm getting very good interest rates on my debt side. But I'm also in and out. I'm not long term with this partner unless I decide I'm going to continue to cycle things up as they grow. So that's kind of the two big buckets there. And then it depends on what asset classes the business falls into on where we might see they might structure beyond that.
Yeah. Yeah. And so really it's like, if you're not independently wealthy and able to fund yourself, your options are, selling equity or selling some ownership, or borrowing money in some kind of a debt vehicle. Some might even argue, even if you did have unlimited funds available, you might still want to use other people's money. OPM is almost like a banner waved in Silicon Valley and other places like that, for sure. What would be a situation where someone would want to use other people's money, even if they did have access to their own resources?
Yeah, so one would be if they're into multiple projects. So if you're into multiple projects, I mean, you see this a lot of time with real estate. If I'm trying to develop out more than one project, it could be something as little on a small scale as saying I've got more than one rental that I want to build out. Then you want to have some liquidity available that you can use to leverage other debt. So you need to keep some of your cash, right? So you're keeping your cash as the investor so that when you need to get capital, you can say, hey, look, I got cash, and you can go get your leverage. So if you can do that, and then you can also access capital from private investors, now you continue to keep your kind of war chest off to the side, and you can keep those projects. You can scale those projects multiple times over, depending on your own bandwidth, if you have kept your own capital and you're not restricted by that.
Yeah. So I'd be interested to know, just in terms of investors, if someone's planning to invest, what would be indicative of an investor who might prefer to be a lender as opposed to an equity owner?
Yeah, I think it depends on what their appetite is for cash flow versus long-term upside. So, and just the caveat to this is I've seen clients do it a lot of different ways. And my exposure to that, what was interesting is when I would see balance sheets and I would see these clients where when I'm introduced to them, I know that they own a business. I'll look at a balance sheet and I'll say, okay, there's their business. Hey, what's all these other little ones? And all these other little ones are their participation into other businesses, them providing capital to other people, and in return getting limited partnership in those. And that could be structured in different ways. That could be a debt piece, or that could be an equity piece. On the debt side, you have somewhat of a relatively known, there's risk involved, but relatively known cash flow on it. You sit there and say, I know I'm getting interest for this period of time. I'm expecting to get interest for this period of time, and then I'm going to get my exit over there. And so that's attractive as part of an overall portfolio for that investor to say, this fits into kind of more of like a fixed income type bucket. And then on that same exact investor, that same portfolio, they may have some where they say, I don't really care about the cash flow because I've got that bucket checked off here, but I want to look for some more of an equity play and get more of an upside on an exit. And so they'll have that structured a little differently.
Interesting. So maybe just to drill into some of the debt financing vehicles a little bit, what would it look like if someone was going to raise capital, get someone to provide some kind of I don't want to use the word bond, but some kind of a debt.
How to structure the debt.
Yeah.
Yeah, there's been a couple ways I've seen it. So what I've seen is just direct lending from one party to another. I mean, if we're really pulling the veil back on things, and some people think, well, I'm not an investor like that. I'm not sophisticated like that. Trust me, when you see these structures and you start to understand some of these things, you realize this is something that if you put a little bit of thought into it, you might come to a conclusion, an arrangement with another party that you want to participate in that. And all I mean by that is if you sit there and say, okay, here's an investor, they're doing a flip, let's just say, okay, they're doing a flip. they need $20,000 to do XYZ. I'm going to go into a private contract with them, a lending agreement with them. We come to terms. It has interest involved in it. And we can just contract that out. Like, you need to get an attorney, you need to get it set up correctly, but it's not a huge mysterious thing for you to have two parties that come to an agreement and go into a contract together. So that's one part. Then you can scale that up into much bigger areas where you say, hey, but I need to have financing from multiple parties, and then you can start to structure into things like syndications might be one way to do that. Another would be convertible notes, and saying, hey, we're going to start off with a convertible note portion, but I'm probably going to be giving up equity later because of that. And but I can pool multiple investors together. And so I'm going to pause there and just say, I'm not condoning those. I'm not promoting those. So from that perspective, I see them used very well. I've participated in some of those myself. But this is, there's my legal disclosure. This is not tax or legal advice about how to structure your debt.
Yeah, I think it's safe, a good idea for both of us to say. We're not lawyers, we're not accountants, but really appreciate just the experience you've had and the exposure you've had to these. Yeah, maybe just as a side note, because I mean, we'll talk about equity vehicles in a minute, but you mentioned convertible notes, and I maybe would also add into the mix the discussion around safe agreements. Could you maybe talk about that space that kind of seems like maybe a safe haven in between debt and equity financing? Just talk a little bit about how those work, because not everyone's familiar with those vehicles.
Yeah, I mean, a convertible note at its core and are typically set up the same way, but you're essentially going into an agreement saying, hey, I'm loaning this money at this sort of interest rate, but then once there's a certain value and a certain equity, I'm going to convert it to preferred stock. So I'm in a sense buying preferred stock, but I'm doing it through this metric, and it's pretty it's illiquid. I can't really call it back, but I have the ability to get some pretty significant upside. So if during that period of time this business grows significantly in value, which you're kind of expecting it to, then when you finally get your shares, they are likely to be worth significantly more than what you originally participated in on the front end. So that's a little bit more of that VC type of establishment. That's not going to be your small business. It's going to be your bigger type of business. Now that note could also go to zero. So you got to remember that too. And it could end up never converting, never be worth anything. You may never get any interest on it. So it's the risk reward aspect.
Yeah. So still a risk, certainly for an investor, but at the same time, it's a little bit of a middle ground for the founder who's needing the capital, but not necessarily wanting to sell as big of a chunk of equity as maybe a straight equity sale.
Correct. Yeah. And they're obviously, you're all working in the same direction of, they want to build something that's going to be really big and significant. Because you help them get that ball rolling on the front end, you're able to participate significantly on the tail end by taking on some of the risk at the front end. Yeah.
So taking a little bit of a dive into equity financing, we all see the deals on Shark Tank, and of course there's a lot of fanfare around those, but probably not as sensational in most cases. But what do equity deals usually look like? What are some of the key contributors? And then from an investor perspective, what makes something look like an attractive equity deal versus one that makes them uneasy?
Yeah, so everybody has a different appetite there, but I think when you're doing your due diligence, you're going to sit there and take a look at the project or the business and say, is this an asset class that I'm comfortable with and I'm familiar with? So a lot of times they're somewhat real estate based, or they might be all their small businesses. So if we go back to the syndication example, they can be structured to where you're an equity investor in that. You're a limited partner in that business. Limited partner meaning you're passive. You don't get to make the decisions on it, but you do get to participate in the cash flow and the eventual exit of that business. So if you're comfortable with the type of business plan they have, who the operators are, what their vision is, what their expected exit looks like, and that fits within your investment parameters, then you might make a decision to say, hey, I'm going to participate in that. Now, in those types of deals, you do need to be an accredited investor. They usually do have pretty significant minimums. Again, those are very much illiquid as well, but that's the private equity space where you have the potential to see significant upside.
Yeah. And with private equity, do you find there are those that just will do a few fairly large type investments, or do people look to kind of spread out their risk over wider ranges?
Yeah, I find that my clients are spreading it out among not just deals, but also sponsors. So the people that put the deals together, that work with certain operators, they may sit there and say, hey, I've got 3 or 4 sponsors I like, because if I have a dozen deals out there, one of them's going to zero at some point. We've seen that in the multifamily space recently, with deals that were put together over the last 2 or 3 years, where part of their whole business model was, we're going to raise capital through equity on this side, but we're going to refinance out with a bank debt in 2 or 3 years. Well, 2 or 3 years later, we're in the interest rate environment we're in, and now they can't perform at what they were expecting to do. So if you've diversified yourself on the private equity side among different asset classes and operators in different markets, then hitting a zero on a couple of those doesn't impact you nearly as much, especially if you're seeing a lot of investors are seeing 20% plus returns in their others.
Nice. And what's deal flow look like, and is it different depending on that philosophy? Are someone looking for lots of deal flow, or are they looking for maybe a lot of different investments but slower flow? Like what's that look like?
Yeah, that is going to somewhat depend on, if you're on the investor side, it's going to depend on how often do you allocate capital. So are you looking at, on people that it's not their primary business, they're doing it on their side, they might only go into 1 or 2 deals a year, or maybe only 1 or 2 deals every couple of years as they cycle out and recycle their capital into it. So when that happens, they're really not listening to deal flow for months on end until they realize, like, hey, I'm coming up on an event where I'm going to have some capital again. So start to pay attention to it at that point. And then typically what I've found is, a lot of times, yes, you're underwriting the deal, but you're kind of underwriting the operator and saying, what's this operator's experience in this space? How have they exited before? Who else do I know that's in it that's had success? If it's a new operator for you, you're going to say, if I don't have anybody else in there that's been through the entrance and the exit with them, that puts more risk on the investor side.
Yeah. And what are some of the things that almost are like the criteria or the qualities they're looking for in an operator? What are some of those key things? Like a lot of times it's like, if you're really passionate about it, people are really going to appreciate that. But then others say, no, it's like, show me your numbers. Like, what are some of the things that make an operator attractive or and invokes caution?
Sure. I mean, certainly experience is the number one thing. So if you have a track record if the operator has a track record of operating inside that particular asset class for a long period of time. So whether that's, we were talking about it before, whether that's multifamily rentals, self-storage is really hot, car washes and other types of businesses, you're looking for somebody who has successfully generated cash flow in those and then successfully exited. So that's on the operator side. And then the promoter, the person that's kind of putting it all together and is going to be the general partner on the deal and is out there finding good operators, you want to see, well, what's their track record actually finding good operators? And then what have they done? The question I ask is, tell me about a deal that didn't go well. What'd you do? How'd you come out on the other side of that? Because that will be indicative of how things might be approached if one of your deals doesn't go well.
Yeah. Talk a little more about the role of general partner and just that whole phenomenon, because I think that's one that often gets overlooked in the grand scheme of things.
Yeah, so general partners in this, first off, take on there is a big liability component, but they're out there trying to find deals. and they're out there promoting them to the investors that they know, accredited investors in the case of these. So again, with that, the tax caveat. So they're trying to put all of those together, and if it's done correctly, they're able to fund these projects, these businesses, using investor capital and some of their own capital, but they're able to participate significantly on the upside. So you string a bunch of those together, or even just a few of those together, it's it's a very successful kind of outcome for the GPs.
Yeah. So they can get a lot of the benefits of it and kind of, I guess, earn in a little bit with sweat equity since they're doing a lot of the
Totally.
so to speak.
Yeah. I mean, what you want to look for is alignment on their motivations as well as the investors. So, for example, there's one deal that I know about where the LPs get the first 7%. So they're getting a preferred return on the first 7% of cash flow, and then they get an 80% split on any cash flow above that until they get their return of capital, and then it flips to 80% to the general partners. So what I like about that is there's definitely other plans that are structured a little bit more generously, like 8 or 9% pref return stays always at 80-20. However, if you think about it from the perspective of what's the motivation on the GP side, they're obviously going to try to get you to return to capital as soon as possible because they want to be on that 20-80 split when you exit the property, because they were going to want 80% on the upside. So you sit there and say, oh, well, I want 80% on the upside. It's like, okay, but they're also motivated to get your return of capital really soon. So they're structured in different ways. You got to sit there and say, which one do I like? Do I like that they're aligned to get me my return of capital? Or do I like that, they're going to try to get the biggest return on the exit as possible?
Right. Well, and it seems like you say, I think the velocity then would be motivated as far as the GP is concerned if they are trying to get there faster, or they're trying to get bigger or go for the bigger payday.
Yeah, there's another deal where it's structured as such that the LPs are all exited automatically once they hit a certain return on their capital. So once they hit that number, you're out and they own it completely. So you sit there and say, okay, well, I know what my return is supposed to be. I just don't know the time horizon on it, right? Like, I don't know if it's going to take 2 years or 5 years or when. And so I like that I kind of have a known but not the known time frame. And then for them, they sit there and they're giving up a lot of cash flow on the front end because they're not getting that split, but they're trying to get you out, and then they own the business. So obviously they get some fees in there. They're not operating for free during that period of time. Right. There's some fees, but they're not getting their upside until they've moved you out. So they've really done more of a debt structure in that sense.
Right. In a sense, it's kind of they're looking for the liquidity event to take place sooner rather than later, because their real money for them starts at the point that
once they exit you. Yeah. They want to get all the LPs out and then take several of those, put them together and sell it off at a multiple. That's the ideal. And you as an LP are like, hey, I don't care. I got a multiple on my investment, and I got out in 3 years, 4 years, whatever it was, and I redeployed that capital into something else.
So what are the kinds of businesses that are conducive to that type of a model with a general partner?
Yeah, so definitely real estate based ones tend to be really good. So I kind of mentioned earlier, self-storage, multifamily can be very much structured that way. I mean, it was kind of eye-opener for me when I realized, I was kind of wondering, how do people buy $50 million apartment complexes? Well, it's not typically one person. It's usually a pool of investors with a general partner that put a project together. So those tend to go really well there. Self-storage has been very popular in that space, but RV parks are a good structure for that. Car washes that I mentioned earlier. So all of these have a real estate component, and why that also works out well with the real estate component is oftentimes the tax benefits that come with the real estate side also pass through to all the partners, whether GP or LP.
Okay, nice. So let's talk a little bit, maybe just expanding on this, the types of kind of investment approaches or the types of business models that someone might enter into with these types of businesses.
Yeah, if you're trying to build out your business and it's more in the manufacturing type space, or it does have a good real estate component, and you see a pathway to scaling, you could sit there and say, hey, I'm going to put some investors together and try to get them to help me scale the business. They would tend to be a really good fit for that. If you have a service-based business or manufacturing-based business, and you are just building that on your own, you're trying to scale it through just the debt that's available to you through lines of credit, small business loans, those types of things, then what you're looking for probably is going to be, you're going to be a really good option for a private equity type of roll-up structure. And while it may sound fancy, all it simply means is this: you have a group that comes in and says, we really like the asset class that you operate in. And let's just use roofing, for example. You have a roofing contracting business. And if we can go through and we can buy up several roofing contracting businesses and get some economies of scale out of them and try to pull those all together, we're also going to let the owners that we bought them from buy back into the new entity that involves all of these. So a lot of times that's 70-30. So you exited at 70% and you kept 30% equity into there. So now you have this ability to actually participate on their vision. You got your liquidity event to start. You probably are still going to operate somewhat inside of their umbrella. And then when they pull everything together, the roll-up pieces, we now have all these businesses are now entity ABC, Roofing Corp. Yeah, and now we're gonna sell it off. And when we sell it off, your 30% might have been worth more than your original 70.
Interesting. And do you find those kind of scenarios have like an earnout period as well, or does that tend to be separate?
Yeah, they do tend to have an earnout. Yep, for sure. Yeah, if you're looking to straight retire, it's probably not going to be to a roll up, but it could. It just depends on if they really want you there or not. And on an earnout component, I mean, you can still have an earnout even if they don't want you there. They just, are kind of paying you to do nothing at that point.
Interesting. Yeah. So what does that maybe look like in real terms? I think, we've talked about, we've got this kind of trend in the world right now. The baby boomer generation is either has retired or is retiring or about to retire. What does that look like for that type of a deal structure?
Yeah, so that's created a big opportunity. There's an opportunity to go buy those businesses as individuals. So if you're an entrepreneur and your choice is, do I want to build or buy, or do I want to buy and then build that? There's some opportunities out there. You have to be able to go and find them. I don't have advice for you on how to do that, right? So, but they exist. There's also this opportunity to say, okay, if I can put a creative structure together, then I can try to snatch up a bunch of those businesses and exit those businesses in a way that's maybe beneficial to their employees. So I'd shared with you before, I've seen the model where there's a lot of boomer-owned manufacturing type businesses that don't have an heir apparent. So obviously family businesses that are going to continue into the family, they have their succession plan baked in. But if you get to the end of that and you don't have a succession plan baked in, then your choices are kind of, can I go sell to a competitor? Sometimes you can't. Or do I want to kind of join forces with other similar businesses? And so there's groups out there that will buy several of those that fall within the same category, and different from the roll-up structure because they're not retaining any sort of equity piece. They're just going off into retirement. So they'll get bought out at that point. But these groups are coming in and saying, hey, these are smaller ones. These are like 1 to 5 million EBITDA, and we're going to buy them up. We're going to have some economies of scale by pooling some of the redundancies on the software, payroll, those types of things together. But we're going to exit to the employees after 5 years through something called an ESOP, Employee Stock Ownership Program. And so what that does for the owner on the front end is it sits there and says, oh, okay, I can go off into retirement because I don't have an heir apparent and they're going to provide one. But it's also, in a few years, it's going to benefit my employees because they're going to be the beneficiaries of that conglomerate that's been put together that continues to operate. And ESOPs fund their retirement, your employee's retirement.
Yeah, interesting. Yeah, I think about like books like The Great Game of Business that, start with like trying to help employees really understand the real business, not just their role in it. and then almost setting the stage for having a very informed employee base and an engaged employee base that could step into an ESOP as owners and really understand how they're going to drive the business forward, not just kind of be employees within the business and have that as a retirement vehicle. So that's really exciting.
I think the ESOP model, I don't participate in those financially in any way. So just seeing them from the outside, I think it's underused, and because people just aren't as familiar with them. But one of the things that you just hit on that's a big upside to them is when you have some ownership of your company, whether you're the administrative assistant or the VP, there is a different mindset that goes into how you operate that business. And owners all the time want their employees to have that mindset, but they'll never have that mindset if they're not owners. And so having an ESOP piece, and by the way, owners can still retain some of their business and ESOP part of the business. That's a whole nother conversation. But that mindset piece that a lot of owners want to have out of their employees doesn't really happen unless you can give them some sort of ownership.
Yeah.
And it shouldn't, if you're not an owner, you shouldn't have an owner's mentality. I mean, that you can't expect that of people.
Sure. So even looking at all these structures, you at least one point we've talked where you have an interesting kind of a structure for the kind of the steps that happen. Maybe if you could just share that 3-step process that you've shared with me in the past.
I'm sorry, which part of the businesses?
Around syndications, I think primarily, but just a lot of the different things we talked about.
Yeah. I mean, part of it is you're going in, you're trying to find an asset that has been underused. So whatever that looks like, it's not been updated. It hasn't integrated technology that's available in that space. Interesting enough, like I know I mentioned manufacturing a couple of times, but there are actually developments with AI and physical manufacturing in ways that you wouldn't think. You think of AI as being a tech-based thing that helps those types of businesses, but there's ways to increase your productivity using it with camera-based systems. That's a whole nother conversation too. But you're going in there, once you start to have these pieces and you're saying, here's an asset that we can do things. The big term that you hear out there is value add. How can we add value to this class? A lot of times the current owner doesn't have an appetite to do it, and they don't have the capital to do it. So if we have the appetite, the idea, and the capital to do that, we're going to go in there and do that. Then we stabilize that under current values, enjoy the cash flow for a period of time, and then we're going to sell that off to exit based on there's large institutional type investors that want to buy all sorts of asset classes that are stabilized and create nice returns.
Yeah. Well, I think that really naturally takes us right into the discussion around exits. Maybe talk about what an exit looks like. Obviously, we've talked about a number of different investment types, which ultimately would lead to different exits as well and different structures. Just maybe talk through what exits can look like in some of those areas.
Yeah, we definitely sprinkled it throughout our conversation. But exits. What I usually encourage my clients when they're looking at, especially in the world of estate planning and retiring out of their businesses, is what is it that you really want to do, and then take a look at all the different options that are out there. So, for example, if I have a client that owns a business and says, one of my 3 children are in the business, so I'm just going to give it to the one, and I typically would say that's a terrible idea. You have to actually kind of structure things out and think about it a little bit differently. Think about control and value a little differently, and then try to really define, well, what is it that you need out of the business into your retirement years? And once you can define that really well, you want to try to structure your exit in such a way that it leaves the business in a really good position to be successful and allows you to get what you needed out of it for your retirement piece. So I'll see that kind of get structured in different ways with gifting and notes and et cetera. If you're going out to other parties, then the question is, hey, are you just really done? Is there a good heir apparent within your business? Can you start to look at, or can you develop one? Do you still have enough of a runway to develop one where you can sell it to them, sell it to your employees, or some combination of both? Or do you need to go out and sit there and say, hey, let's try to exit the private equity? And does that get also what I need to exit? Are they going to bring something to the table that's going to benefit my employees, i.e. additional capital to invest in our space? And you start to, you really, the thing I caution people on is not to hear about an idea and then go and try to make that fit. You really need to go out there and find some advisors that will say, hey, let's figure out what you need to do, and then go look at all the ideas and narrow them down through that filter to only the ones that fit within what you're trying to do, what's actually important. And take another big caution is just kind of take the ego number off the table. So I'll see sometimes people say, my business is worth $20 million. That's what I want. Yeah, no, what you really want is some number net. And so if you can get that number tax efficiently and it's structured a little bit differently and it benefits other parties as well, let's try to get to that scenario and not just ignore those other options just so you can say, I sold my business for $20 million.
Interesting. And so what would be some examples of ways that you might manage that? Or what are some of the levers you'd pull if someone was like really determined to get a top line number versus, what's that outcome they're looking for? What are some of the options they might consider?
Yeah, if somebody's really, really wants that top line number, you really want to lay out, well, what are all the tax implications of that top line number? And if you really accept all those implications, both on the income tax side and presumably if you're selling a $20 million company on the estate tax side, let's all take a look at all of those implications. If you still really accept all of those, then go ahead, sell it that way. And if you don't, but more than likely in that process, you'll start to say, okay, you know what, it's better if I do it this way, or it's better if I do it that way. And, if I can move some of it to a trust, then that's probably wise. Why don't I pump the brakes on this for a minute, be intentional about how I'm doing it and try to structure it right.
Yeah. And as far as founders, I mean, we touched a little bit on earnouts, and what are some of the decisions a founder might have to make when they're exiting their business, just in terms of how they sell it, how much they keep or sell, what their role is in the business or not? Like, what are some of those trade-off decisions that they often face?
Yeah, I mean, the big one is what you just mentioned. Like, am I in it or not? And do I want to be involved? And I think you have to be honest with yourself and say, is me still being involved a detriment to the business? And then also look at, well, who's the business going to? If it's family versus an outside source, or is it employee, a specific employee, then you have to sit there and say, am I able to empower them? Or am I honestly going to be in the way, and they need to be able to have the reins to go and try to build it out how they want? Now, if you want to give them the reins to go and build them out, you should probably get your get your payout sooner than later, so that you're not naturally drawn back to trying to control things because your retirement's on the line.
Yeah. Yeah, that's really good stuff. Yeah. Anything else that comes to mind when we think about launching or growing a business using other people's money, or even from an investor perspective, what a founder might need to be thinking about if they're trying to go down that type of a path?
Yeah, I think if you have to be pretty honest about the type of business that you're in and how people scale it in the first place. If you're just not in the type of business that people do go and get outside capital to grow, then don't worry about that. Go look at the more traditional routes of getting additional money through SBA or through lines of credit, those types of things. And then also look at partnering. Is there something that you can bring a value to some other type of business that's either vertically aligned with you or even horizontally aligned with you, where you can start the partnership and start to do more of a rev share and try to grow that way? That tends to be, the way that you're going to grow a quote unquote smaller business that isn't set up to take on outside private equity.
Yeah. What advice would you have for a very early stage founder just getting started, even just in terms of like things to be thinking about early that may have long-term benefit for them?
Yeah. So early on, I would say make sure you're getting really good tax and legal advice, of which, of course, this is not. And we mentioned that earlier, right? So I would look to peers that are in the direction that you're heading and start to talk to some of their advisors. Because I think on the front end, there's a wealth of knowledge out there around a lot of different things that we can learn. But you also want to have those experts that sit there and say, okay, yeah, here's how you should actually structure your business right now for these reasons. And sometimes that money spent is saves you significantly more later.
Good. Well, Stephen, this has been great. Thanks so much for your insights and just sharing your experiences. I think this will be really valuable for those that are trying to navigate this landscape.
Yeah, thanks for having me on. It's always enjoyable having our conversations together.
Awesome. And for anyone watching, if you like to see more interview, or if you'd like to see more interviews like this, or if you'd like input on how to be effective as an entrepreneur, as a founder, as you launch, grow, and thrive, check out the channel, subscribe to the channel, and just keep an eye out for more like this. We look forward to seeing you again in the future. Keep going.